Hi, everyone. Happy Thursday. I hope 2026 has been treating you all well so far. It's hard to believe we're almost at the end of the first quarter already. Perhaps you had the chance to take some time off for the March break, but if you didn't, I hope enough of your colleagues did so that your inboxes were a little bit quieter for a while. I'm Sinead Gleason. I am a product lead at Equifax Canada, and I'll be taking you all through the credit trends today. As usual, though, we're not here to talk about the here and now. We're going to travel back in time to the fourth quarter of 2025 and reflect on how things shaped up in the fourth quarter. And that is, a very critical period for most businesses in Canada. And we also have a very special guest joining us today, one of our truly great business partners, Steve Carpenter, Chief Operating Officer of North America at CreditSafe, is going to take us through some of the international business credit trends. But I will pause here for a moment. If you've joined us for previous webinars, you might have noticed some changes with your experience. So I'll pass things over to my colleague, Jordan, who will go through some housekeeping items. Jordan, over to you.
Thank you, Sinead, and good afternoon, everyone. Welcome to the first Business Trends webinar of 2026. Thanks so much for being here. As Sinead said, my name is Jordan, and I'm here to help navigate the webinar display in front of you. Just a heads up, if you're having any sort of issues with the sound or video, please click the help button in the bottom left corner and run through the steps. All the way on the bottom right side of the screen, there is an ask a question box. So feel free to click that, enter any questions you may have, and we'll try to address them throughout the session today. In the event that there are too many questions to get through, we will reach out to you individually to follow up in the coming weeks. Polls. If you click on that box, you'll already see one up asking if you'd like to be contacted by an Equifax representative. If you click the box called apps, you'll see a couple of interesting things. First, under links, you'll find our survey and also a view into our International Business Credit Report page. In the handouts box, today's presentation in English and French is available for download, along with a lot more great material. Lastly, the session is being recorded and you will receive the on-demand link via email tomorrow. Now that is all from me. Please do me a favor, give a thumbs up from the reactions button at the bottom of your screen. And Sinead, back over to you. Oh, Sinead, you're on mute.
Thank you. Okay, so as we always do, let's start with the big picture, which will help ground us in the macroeconomic environment that Canadian businesses were experiencing in the fourth quarter. And of course, we can see that Canadian GDP growth appears to have stalled. On the left side of the slide, we show the change in GDP over time since Q1 of 2023, with the red bars being GDP at market prices and the gray bars being GDP per capita. And then on your right-hand side is the change in Canadian population since Q1 2019. The big news item dominating the headlines in 2025 certainly was the international trade uncertainty and volatility. The economy shrank by 0.6% on an annualized basis. StatsCan indicated the primary reasons for that decline was largely driven by businesses selling off existing inventories rather than producing new goods. Business capital fell as investment in residential and non-residential structures declined. Housing declined as fewer people were buying and selling homes or even renovating. And some sectors saw wage decreases. So, for example, educational services and construction. And you'll recall there was a temporary postal strike and even a semiconductor shortage impacting auto manufacturers in November. But those challenges were then offset by things such as high global demand for Canadian gold, aluminum, and alloys. And so exports rose by 1.5%. Household spending rose by 0.4% as Canadians spent more on rent and financial services. And there was a massive 45.9% annual increase in government investment in weapon systems, which gave a boost to the capital investment category. So on balance, even though we saw population contraction of about 76,000 people, the GDP per capita rate remained flat. There we go. Okay, so looking now at inflation numbers, the chart you see here shows a percent change over time starting from January 2019 to January 2026. The consumer price index is the gray line, the industrial products price index is red, and the raw material price index is green. In December, CPI rose 2.4% on a year-over-year basis. And this was driven by a few factors. So you'll recall that we had a temporary GST HST tax break in December of 2024. And so with that back in place, consumers were paying more for goods than they did the same period the previous year. Food purchased from stores rose over 5% year over year in December, driven by coffee at 30.8% growth and fresh or frozen beef, which reported 16.8% growth. Offsetting those factors was the price of gasoline, which reported a year-over-year decline of 13.8% in December. Remember those good old days when gas was less than $1.50 a liter? Well, we'll see how those numbers change next quarter. I'm sure there will be some differences, but I digress. And so looking at the factors affecting CPI, we can see that the industrial price index rose 4.9% compared to December 2024, and the raw material price index was up 6.4%. The increase in prices for the products that were produced, so the IPPI trend, those numbers were driven by precious metals and food products. The December period saw unprecedented growth in silver, which reached 106.6%, platinum at 82.4%, and gold was up 57.8%. Food prices were driven up by increases in poultry, and that was up 38.5%, and beef and veal, which was up 19.7%. And when we look at the raw costs of materials or the input costs, we see that the RMPI was up by 6.4% year over year, and that was largely due to increases in metal ores and concentrates, which rose 74.4%, and livestock and animals, which was up 13.2%. Both the IPPI and the RMPI would have been higher, but the price of crude and energy declined significantly in December. So again, we'll see how that all changes next quarter. All right, next slide. I'm navigating this new environment as well. Okay, so now we're looking about international trade. I must have skipped a slide, did I? Yeah. Imports and exports, job vacancies. I think I skipped a slide. There we go. Okay. So what about international trade? So in December, merchandise exports increased 2.6%. Thanks for the thumbs up. And imports were up 0.6%. So our merchandise trade deficit with the world narrowed from 2.6 billion in November to 1.3 billion in December. In terms of exports, gold rebounded and exports of aircraft and other transportation equipment and parts reached a record high. But overall, the rise in exports was almost entirely driven by those non-metallic mineral products, which was up 23.4%. Exports to countries other than the United States rose 5.8% in December to reach an all-time high. Increased shipments of unwrought gold to the UK contributed the most to that growth. And then on the import side, imports of passenger cars rebounded and gold imports rose too. Imports from countries other than the US fell 3% in December. Okay, now let's look at the employment numbers. On the left side, we're comparing the total number of employed individuals in the gray line to the employment ratio in red. The employed number is on the left-hand side axis, and the employment ratio is on the right-hand side axis. And on the right side of your screen, the bars represent the job vacancies, and the red line is the average hourly wage. In both those graphs, the big thing that kind of jumps out visually is the continued sort of divergence of data points. On the left, we see that the number of people who are employed remained at an all-time high, and yet the percentage of the population working continued to decline. So that illustrates that the population grew faster than the labor market could create jobs. And the decrease in jobs came from full-time employment. And then on the right, you'll see that again, as job vacancies fell in Q4 after a brief bump in Q3, and the average wage continued to climb, but at a slower pace. And on a year-over-year basis, the average hourly wage was up by 3.3% to sit at $28.45 per hour in the third quarter of 2025, which was a slower growth rate compared to the second quarter of 4.5% and the growth in the first quarter, which was 6.1%. Labor costs are rising due to continued inflation, but also multi-year union contracts as well. And it's clear that businesses are pulling back on hiring. Okay, by December, the employment numbers had stabilized and the unemployment rate had grown slightly by 0.3 percentage points to 6.8%. Demographically, employment rose among people aged 55 and older and fell among youth aged 15 to 24. And in terms of employment type, full-time employees rose by 50,000 positions, while part-time employment fell by 42,000. Regionally, employment was up in Quebec, while it fell in Alberta and Saskatchewan, and there was little employment change in other provinces. And as for the various sectors that saw gains and losses, the gains came largely from healthcare and other services, which includes personal and repair services, whereas the largest declines came from professional, scientific, and technical services, accommodation, and food service. Okay, now we will look at the business openings and closings. And the drop that we saw in October was recovered in November. By November, the business opening rate had increased to 5%. The opening rate was actually 0.3 percentage points above its 2015 to 2019 historical average. And the number of active businesses was up slightly by 0.1% because of an increase in the number of business reopenings. So things like seasonal businesses would be captured there. I don't know if slides are flipping around for everybody else, but I think they're flipping around for me. So I'm going to try and stay stable. Okay, so finally, looking at retail sales and retail sales. Q4 saw a decline in total retail sales by 0.4% to $70 billion in December. The decrease in sales were led by motor vehicles and parts dealers. Core retail sales, which excludes gas stations, fuel vendors, as well as motor vehicle and parts dealers, those were also down by 0.3% in December. Canadian corporations reported operating profit of $205.6 billion in Q4, which was up 1% compared to Q3. And that was driven by the non-financial industries. And these numbers were up compared to the same period last year by $14.1 billion or 7.4%. Okay, so now let's take a look at how all of those macroeconomic factors were weighing on the minds and operations of Canadian small businesses. And so if you're joining us for the first time this quarter, the data that you're looking at here comes from the Canadian Small Business Health Index. This index comes from a combination of survey data collected by BDC, so Business Development Bank of Canada, Equifax Credit Risk Bureau data, and macroeconomic data from StatsCan and the Bank of Canada. Our aim is to help inform business decisions about strategy and investments. It's made up of 4 key components, which includes credit performance, business growth projections, business confidence sentiment, and business environment. And the national index dropped in Q4, falling to 98.4, which was a 1.2% quarterly decline and a 2.4% drop year over year. But despite trade tensions last year, overall, the Canadian economy remained resilient, in part due to the Canada-United States-Mexico Agreement, or CUSMA, which continued to protect most Canadian exports as it actually limited the impact of tariffs. Provincially, Atlantic Canada and BC were the only regions which saw their index scores rise in the fourth quarter. And I'm going to jump a little bit all over the map for a second, so try and follow along, but we'll start on the two ends of the country. Atlantic Canada showed a resilient labor market, and rising wages, which helped the index rise to 99.6. And that was a 1.2% quarterly increase driven by higher consumer spending. In BC, the index rose to 97.6, continuing a steady recovery as sentiment strengthened and entrepreneurs reported improved expectations for 2026. And then conversely, Ontario had the most significant year-over-year decline, with its index dropping 3.7% below 2024 levels. In that province, small businesses faced a really difficult year with the index falling to 97.6 as tariffs and persistent economic uncertainty weighed on sentiment there. On a quarterly basis, Manitoba and Saskatchewan saw the sharpest decline, falling 4.4% to 101 from their Q3 peaks as credit performance worsened and sentiment also softened. In Quebec, the index remained essentially flat in Q4 as businesses adopted a defensive stance due to sort of softening economic conditions and trade uncertainty. And then in Alberta, despite a slight ease to 100.7, the province actually remains one of the strongest positioned due to robust employment, population growth, and high oil production. All right, next. On your left on this slide, we're looking at the index numbers trended from our benchmark period of Q1 2022, and you can see how it really reflects the ebbs and flows of the economy. Plainly, the optimism that we'd seen this past summer faded pretty quickly in the fall as the U.S. introduced a new wave of tariffs targeting softwood lumber, upholstered wood products, and kitchen and bathroom cabinets. And on the right-hand side, you see the four factors that make up the index. And the decline that we see overall is largely attributed to a weakening business sentiment as expectations regarding cash flow and economic conditions over the next 12 months began to deteriorate. Tightened credit access had fewer businesses reporting that financial institutions met their needs. And then growth projections fell, with credit performance reaching its lowest level since the index began. Declining sales and hiring expectations, combined with rising bankruptcies and late delinquencies on supplier credit, pointed to deteriorating financial health among Canadian small-medium enterprises. And while the business environment component remained resilient, ongoing weakness in credit performance and growth expectations could eventually start to weigh down that component. So economic fundamentals actually remained pretty solid last year. In 2025, lower interest rates had a positive impact, and we saw overall growing consumer spending. The economy still added jobs in 2025, and sectors that were impacted by tariffs regained most of the losses that incurred earlier in the year. By October, exports had climbed back to the 2024 levels. But the heightened uncertainty that kind of characterized most of 2025 also brought greater volatility with it. Business sentiment reacted sharply to new U.S. policy announcements. And in Q4, trade tensions had really intensified, and small and medium enterprises started to shift to a more pessimistic outlook. In addition, by Q4, we began to see softening consumer demand and rising price pressures weighing on small business finances. So with uncertainty expected to remain high in 2026, we expect fewer businesses to pursue major growth plans, and that could ultimately dampen investment in Canada. Okay, and looking at some key industries, manufacturing reported a quarterly improvement of 6.1%, returning to slightly better levels than we'd seen even in Q4 of 2024. It now sits at 97.6, driven by improvement in the economic environment. And then on the flip side, the index for retail and wholesale trade declined this quarter by 4.6% to sit at 95.3. And that was driven by declining sentiment within that particular sector. Okay, so we've now arrived at this quarter's credit data. And first, we'll examine credit growth indicators. And what we'll see over the next few slides is growth in credit demand. We'll see a continuation of a trend that started becoming more prominent last quarter with respect to a changing dynamic between financial trade and supplier trade repayment behavior. And as well, we'll look at which sectors of the economy are feeling strain more than others. Let's dig in. Okay, so first we'll look at debt levels. On your screen here, on the graph on your left, you're looking at the average debt per business by age of that business. So we have startups or newer businesses on the far left, and then more established businesses on the right. The orange bars are Q4 of this year compared to gray Q4 of 2024. And then on the right-hand side of your screen, we break down the balances across the various financial trade product types. Overall, average business debt rose 16.9% year over year to reach just over $30,000. Newly established firms under 12 months old drove much of the increase, with balances growing there at 64%. Despite rising debt levels, the number of businesses missing a payment declined by 11% year over year, which is certainly really good news. When we look at the credit mix trends, the data is suggestive of restructuring. And that's because installment loan balances increased almost 22% year over year to 132,000, while credit card balances declined by 5% and lines of credit fell by 14.7%. So businesses appear to be locking into structured borrowing and pulling back from revolving credit exposure, which tends to be costlier. And then where was that demand for credit coming from? So when we look regionally, there's a real divergence between provinces and territories, and you can almost draw a line, right down the center and across the middle of the country. Quebec reported the strongest growth at 11% in inquiries. We're also seeing positive momentum in the north, specifically the Yukon. However, out west, we see the opposite. Starting in Manitoba and going west right out to BC, each province reports year-over-year declines in demand for credit, ranging from -3% to -5%. Ontario's demand for credit was flat compared to the same period last year. And when we examine the demand by sector, we can see that all major sectors, with the exception of accommodation and food services, saw declining levels of credit demand. The pullback was most pronounced in transportation and warehousing, which saw a drop in inquiries of just over 11%. Okay, here now we're looking at origination. So in other words, the number of new accounts. On the left of your screen, we break this data down into two segments: financial trades and supplier trades, which we refer to as industrial trades. And then on the right of your screen, we're looking at the mix of new accounts by product trended over time. The line graph shows us that after that dramatic spike early to mid last year, originations returned to a growth trajectory in Q4, with originations growing 13% overall compared to Q3. And then on your right, you can see the changing dynamics actually of the product mix over time within the financial trade specifically. This same quarter last year, cards accounted for nearly 80% of originations, but that's really shrunk down to 72% as installment loans have grown to 22%. And that shift points to a lending environment that's beginning to focus less on short-term flexibility and more so on longer-term repayment stability. And when we put that in context of the health index numbers that we looked at earlier, that really makes sense. Given business sentiment is weaker and we saw lowered growth projections, this kind of credit environment, lenders kind of prefer installment loans as they offer fixed and regular terms for the borrower and predictability for the lender. When we drill down into those installment loans originations, in the graph on your left, we can see a drop in the overall number of new accounts opened in Q4. But also the average size of those loans has continued to come down too, and it now sits around $90,000. On your right, we're looking at the risk profile of the new accounts overall. The first two bars are the financial trades, and then the last two are the supplier trades. And we're comparing this quarter to Q4 of 2024, broken down by score bands. Let's go back to that because my slide. Okay, there we go. The score bands, where was I? And what's notable here is that underwriting disciplines are reflecting a decision to limit risk. Supplier lenders they've always tolerated a bit more risk than the banks, but you can see both holding pretty steady. The FI trades actually saw a 1% growth in the number of accounts in the lowest risk tier, while on the supplier side, we see a bit of a shift where the medium to high risk accounts are now taking up less of the overall mix. And those lenders are focused more on the low risk tiers now than they were the same quarter last year. Okay, next we look into delinquencies and average balances. So over the past 5 years, we saw the number of businesses with at least one missed payment spike in 2024. And while that number has come down in Q4 2025, it's still an elevated level from what we had seen from 2021 to 2023. And on the balances side, the average balance on installment loans has stabilized over the last several quarters, while cards and lines of credit have dropped. And that's likely due to a couple of factors. So firstly, some lenders are beginning to remedy some problem accounts by offering debt consolidation loans. And as I mentioned earlier, that allows not only for predictability in payments for the lender, but also lower rates and more repayment stability too for the borrowers. But also, some businesses will have been taking on larger structured debt for equipment or fixed assets. And then recapping the business growth data for Q4, we saw that as the economy contracted slightly at the end of 2025, some small businesses were encountering intensified financial challenges. We saw weaker business sentiment as small medium enterprises shifted to a more pessimistic outlook as trade tensions heated up. Due to that increased uncertainty, fewer businesses are expected to pursue major growth plans in 2026, which in turn is expected to dampen overall investment in Canada. While the manufacturing sector demonstrated improvement in both delinquency rates and health index, service-oriented and interest-sensitive industries remain burdened by elevated borrowing costs and weakening consumer demand. And then regionally, we saw a noticeable difference in economic health and credit demand across the country. Out east, Quebec saw growth in credit demand, and the Atlantic region saw an improved health index, which was supported by a resilient labor market and higher consumer spending. In Ontario, credit demand was flat, and it also reported a drop in the business health index. This particular province's exposure to manufacturing made it particularly vulnerable to new tariffs. And then out west, we saw weakened credit demand, with Alberta being well positioned for 2026 due to robust employment, population growth, and high oil production. Okay, and now we'll look at the delinquency trends broken down by supplier trades and banking trades and see how things evolved in the fourth quarter. Okay, first up, we will look at the supplier side. These are the lending relationships that exist between businesses, so accounts receivable data, as opposed to the banking relationships like credit cards, loans, lines of credit, that type of thing, which we will look at next. But here, we actually see a nice trend continuing that we've been watching for a few quarters now, and that is that the delinquency rates on industrial trades are once again declining. The 30-day delinquency rate is now sitting at 9.7%, which is single-digit territory. I've been doing these trend presentations since 2022, and this is the first time that I've ever seen the 30-day delinquency rate on supplier trades fall below 10%. So that's really notable. Even at that low point there in Q2 of 2023, it was only 10.4%, so still double digits. As well, late stage delinquencies are also down this quarter, with 90+ day delinquency rates having dropped 0.2 points to sit at 3.2%. This is true across all provinces, but Alberta reported a particularly notable drop among the 60+ day delinquency rate, which was down 28%, and it now sits at 5.9. Now, while all of this might seem like a really positive story of resilience of Canadian businesses as they work hard to maintain supplier relationships, keep goods and services flowing, keep your customers happy by keeping your suppliers happy, there is still a little bit of caution to be aware of. And as we'll see next, the funds which have been freed up to ensure suppliers are well paid and to keep commerce flowing, it might have come at the expense of banking obligations. As interest rates have come down, and as we saw, there was some of that debt consolidation happening, this has freed up some capital. But let's take a look at how things are shaping up on the banking side, because you see a slightly different story there. Okay, here we're looking at the financial trades. So these are loans, lines of credit, and credit cards that borrowers have at the banks. And then while delinquency rates on the financial trades have been trending upwards for the last many quarters, things actually look like they're starting to stabilize in Q4 compared to Q3. The 30-day delinquency rate was mostly unchanged, dropping 0.01 points to 3.78% this quarter. Pre-pandemic, we were seeing levels of around 4.5%. So given the upward trend, we're still not seeing the same degree in delinquency rates with the banks that we saw back then. Regionally, Quebec stands out as it was the only province to see a drop in delinquency rates, with the 60-plus day rate dropping from 3.31 in Q4 of last year to 3.27 this year, which is perhaps not too surprising given that Quebec saw stronger employment growth and has the lowest provincial unemployment rate nationally. Okay, next we'll look at those financial trades broken down by product. And that's on your left-hand side, and then the age of business on your right. Here we see that the rising delinquency rate trend persisting across all three major products: installment loans, lines of credit, and cards. Consistently, year over year, the delinquency rates have risen across all three, but there has been a more pronounced increase within installment loans particularly. Whereas cards and lines of credit, they've slowed this year versus last, but on installment loans, the pace has actually accelerated. It's grown by 12% this year, reaching 3.94%. And where we see the repayment strain is within those newly established business, but I don't mean the startups. So if you're looking at those segments in the middle there, it's the 24 and 48-month-old businesses that show the most strain. And actually startup businesses, or those who've been in business for 12 months or less, they're reporting a decreased rate of delinquency compared to last year. And that really illustrates how lenders have kind of tightened up their lending criteria over the past year. Those startups are still operating on the initial launch of capital, so they have the liquidity readily available to make their early loan payments, while older businesses, they have a more complex debt structure and a much different cost environment now than when they first started up. So things have changed considerably for those businesses. And what industries are the ones illustrating the most strain? So this quarter, we saw the highest overall rates within accommodation and food service, which reported a 5.9% delinquency rate on financial trades. That's the blue line that you see at the top of the graph on your left. And that's followed by transportation and warehousing in orange, which now sits at 5.5%, and retail trade, which is the pink line at 4.4%. The sectors that saw the lowest level of delinquencies, those are on the graph on your right. Those would include healthcare and social assistance, which had the lowest overall delinquency rate at 1.7%, followed by agriculture, forestry, fishing, and hunting at 2%, and management companies and enterprises at 2.9%. Almost all sectors experienced year-over-year growth in delinquencies, with several seeing jumps of over 20%. Real estate and rental and leasing saw the strongest year-over-year increase at 25%, followed by public administration, which was 21.8%, and finance and insurance, 20.6%. The only one to see improvements year-over-year was agriculture, forestry, fishing, and hunting, which was actually down 2.4%. And then looking a little bit more shorter term on a quarter-over-quarter basis, information, transportation and warehousing, and healthcare and social assistance were the sectors with the highest quarterly growth in delinquencies. Whereas on the improving spectrum, we have, once again, agriculture, forestry, fishing, and hunting, followed by management companies, wholesale trade, and then retail trade. All right, finally, let's look at insolvencies for this period. And then on your left are the proposals and bankruptcy numbers trended all the way back from the pre-pandemic days, starting at Q1 2018. And then on your right, we see the provincial breakdown for this quarter compared to the same period last year. And what I personally find interesting is that we had sort of expected that insolvencies would eventually return to pre-pandemic levels after, we saw that massive spike in 2024, when the backlog of files that had paused during the lockdown started to work through again. But we haven't actually seen a return to those pre-pandemic levels yet. So it's looking like things were trending in that direction, but then this quarter we saw a little small uptick. So it's safe to assume that those levels will remain elevated for a little while longer just yet. And then recapping this quarter's delinquencies, we saw a continuation of declines for industrial trades, which is really helping stabilize supplier relationships. But this has potentially come at the expense of banking obligations, which is a trend for lenders to be cautious of. Regionally, Ontario recorded the highest financial trade delinquency rate nationally, and Quebec stood out as the only province to post a year-over-year decline in financial trade delinquencies, which was supported by stronger employment growth. Real estate and rental and leasing is seeing one of the steepest increases in 60-plus day delinquency rates, and delinquencies peaked within the accommodation and food sector. Conversely, healthcare and social assistance, and agriculture, forestry, fishing, and hunting, which I find a mouthful to say, has the lowest overall delinquency rates. And so what can you as lenders do with all of this information? You need to continue to remain vigilant and apply disciplined scrutiny to rate-sensitive industries and regions experiencing spikes in financial stress, while also looking for growth opportunities in stabilizing sectors in stronger regions. And monitor the shift in payment prioritization. Businesses do appear to be prioritizing day-to-day operational survival over servicing bank debt. A company that's in good standing with its vendors may still be highly stressed on its bank loans and credit cards. Keeping in mind that Q4 reflects a critical period of time for many businesses, it's often the quarter that will make or break a company's year. And as we head into 2026, one major thing that's looming, which will have a real impact on Canadian businesses, is the Canada-US-Mexico agreement. That deal was originally signed in 2020, and it's set to expire fully in 2036, unless the three countries agree to keep it going. A formal review of the agreement is supposed to happen 6 years after the initial signing to make that decision. 2026 is that year. So depending on how that review goes, international trade landscape could face a major upheaval. Given current events and the timing of this review, Prime Minister Carney has been looking abroad to new markets in an effort to diversify our trade relationships, but also many businesses are also looking beyond North America for new markets too. And given all of that, we thought this would be the perfect time to bring in one of our esteemed business partners who's very uniquely positioned to share some insights about international credit trends. So joining me now is Steve Carpenter from CreditSafe. Hi, Steve. If you want to go, there you are, off mute, off camera. Awesome.
Off mute.
Would you mind introducing yourself and telling us a little bit about CreditSafe?
Sure. Thanks, Sinead. So yeah, Steve Carpenter. I'm COO for CreditSafe North America. I'm based here in Toronto. I've been in Canada for about 6 years. I relocated here from the UK when we set up the CreditSafe and Equifax strategic alliance back in 2020. I've been with CreditSafe for 23 years. So prior to that, I worked in all of CreditSafe's international operations around Europe, when we established our US operation, our Japanese operation. So yeah, quite a long time basically dealing with private company credit data around the world.
Yeah, and so speaking about like the data that you deal with, can you just kind of explain and set the stage for everyone listening today? At Equifax, the way that we gather our data is largely through trade suppliers and also banks. So we get data that's reported to us on private companies, but obviously we don't have data on all Canadian businesses. But things are very different globally. Like each country kind of treats things differently, right? In terms of the way that you get your data. Could you explain a little bit about how that works?
Yeah, so I thought this would be quite a good like little visualization. So until I relocated to Canada, I obviously knew Canadian data on private companies was challenging compared to other countries. Like, so compared to Europe, as an example, private company data in Canada is probably the worst in the Western world for government disclosed data, which is, it seems a weird thing to say because Canada is such a developed country, but the way the provincial registries work, the way data on private companies isn't released and isn't publicly available, the way there's no like sort of director ID numbers where you can match a director across multiple companies is a real challenge, especially when it comes to fraud. There's no financial statements available on private companies, only public companies. And you compare that to Europe, where I'm going to go into this on the next slide. I've got like a little visualization here of what type of data is available. So when you look at Europe, you've obviously got company profile data. Every single company, whether you're a 5-person private company or a huge public company, you'll always have financial statements, a balance sheet, profit and loss statement. You can calculate ratios from that. Full negative data, director data, even shareholder data, where every single company, you know who the people are behind the companies, percentage of the shares they hold. You can drill down to beneficial ownership and persons of significant control, and it's all publicly available data. In Canada and the US as well, obviously it's slightly different because you don't have those director linkage numbers. You can set up a company today, it goes out of business. You can set up another company tomorrow. And it's very hard to trace that company back to the previous company, which is why it's so difficult here. So we've always joked to be a credit manager in Canada is probably one of the hardest jobs, and they're the best credit managers in the world because they're working with such limited data. Whereas when you're working in other countries, you've got such rich data to work with, even on tiny, newly incorporated companies.
Yep, I would agree. I've met some of them. I would agree.
Yeah. So what I wanted to do as well is like just talking about payment data. We've got a little section on trade payment data and how late do companies pay their bills and how does that compare in Canada compared to how it looks in the rest of the world.
Yep.
But I do think as well, like talking about the lack of public data available on private companies in Canada, what it has led to is it has led to this sort of community feel where most companies or lots of big companies, even small to medium-sized companies, share trade payment data. So
Yeah.
the culture in Europe for sharing trade payment data isn't that strong because historically you've always had financial statements on a company, and if a company's been in business for more than 18 months, you can see their financials. You don't necessarily need to see how they're paying their bills because credit decisions are based on financial statements. Here, because of the lack of financial statements, it's almost like credit professionals have taken it upon themselves to share payment data together to create these industry groups that don't really exist in Europe. So everybody helps each other by saying, these are the companies that pay me late, these are the companies paying me on time, sharing trade payment data, which again, that's a credit to Canada, to the US as well, that they've had to do that to create visibility on private companies. So what I wanted to look at, you just ran through like Canadian insolvencies. These are the insolvency rates we've seen across US and Europe. So these numbers we've got here are going to be a little bit higher than the official stats because we take into consideration like different stages of insolvencies, administration, and things like that. But when we look at it, one thing that's quite staggering is when we look at the US, we've only got a relatively low number of annual insolvencies in the US when you consider it the size of the country. You compare that to Italy, even France here. And I think a big reason for this is when you look at Europe, most companies or a high number of companies go through official receivership or insolvency or bankruptcy proceedings. And a lot of it is publicly available data. In US and Canada, especially, so many companies just shut their doors without ever filing any sort of official paperwork. They just literally go out of business. They shut their doors, which is why it's so difficult to manage credit risk when you're dealing with companies that will literally just shut their doors tomorrow. And that trending information of how companies are paying their bills and collection cases is so important leading up to that. So based on that, we've looked at like what are the sort of highest risk industries. And again, I think these are pretty much consistent across the world. I don't think you had like industry pieces in your presentation, Sinead, but construction, retail, food and accommodation, those are the three highest risk industries in our stats in terms of insolvencies and bankruptcy rates for Europe and US. I think when we spoke yesterday, you said it's a similar outlook in Canada. Those always tend to be the three highest risk industries.
That's right. Yep.
So then we look at days beyond term. So I know in Canada, Equifax have something called the PI, the Payment Index, which is basically your index of how late does a company pay its bills. So what we've done here is we've just broken out the US to start with. We actually call it days beyond terms. So on average, how late does a company pay its bills? Back in 2020, it was 22 days late. 2025, it's only 13 days late. So even though there's a couple of anomalies on here, the gradual trend is that companies are paying their bills on time. Well, 13 days late, we'd still class as normal. Most companies don't pay the bills on time. It's always between 10 and 20 days late. So the fact it's now 13 in the US, there has been a drop over the last few years there.
So that's consistent, right, with what we were seeing, even in.
It is.
Yeah, that's interesting.
It is consistent. 2020, you'd expect to be higher. We'd have thought like 2021, like insolvency rates would have gone up as well, but they didn't really. When we look at the stats, there wasn't a huge spike in insolvency rates. And then we look at Europe, days beyond terms in Europe. So in Europe, as I said, it's less common for companies to share trade payment data. And we're talking here about industrial trade. We're not classing financial trade here. This is basically how does a company pay a net 30 supplier invoice. Again, it always averages, like Italy is the highest, or normally the highest, in terms of they pay their bills the latest across Western Europe. But when you look at UK, Netherlands, Sweden, Germany, it always ranges from like sort of 8 to 12 days late. So it does feel like it's relatively consistent across the world.
Yeah, that's interesting. Interesting that Italy had such a huge spike back there.
Italy had a huge spike back in 2020 as well. Yeah, everything seems to have flattened out now over the last few years. So then what we wanted to look at as well is one of the things we talked about was the relevance of Canadian companies globally. So CreditSafe, we're in a good position because we've got offices all around the world. We have huge numbers of companies who use our credit data in France, UK, Germany, Italy, Belgium, Netherlands, and so on. So what we've done is we've looked at those customers that use our credit data in those countries. Are they looking at Canadian businesses? Because they have access to credit reports on Canadian companies as part of their annual subscription. So we're looking at, are they looking at Canadian companies, and what's the sort of growth rate? So this is really interesting. Over the last 3 years, pretty much every country in Europe is looking at more and more Canadian companies every year. And these are the sort of smaller companies in Europe that are looking at Canadian businesses. You can see there's a huge spike in Netherlands.
Yeah.
So there was 14,000 Canadian reports that were looked at by customers in Netherlands last year in 2025. And then if we go into the next one, US, Germany and France, these are the bigger users. And what this typically would mean is it will mean that why is a company in France looking at a credit report on a business in Canada? It's probably because that company in Canada is either buying from them or selling to them. So it's that Canadian company is trading with a business in France, either buying or selling. And that's the reason our French customers are looking at that Canadian company. So again, France has spiked, Germany has spiked, US massive. Of course, it's by far and away the biggest trading partner for Canada, but a huge number of US companies are looking at Canadian credit reports. And then what we've done here is we've consolidated this to look at, in total, across all of the countries where CreditSafe operates, so US, Japan, and Western Europe, how many Canadian credit reports are being pulled by our customers, but also how many unique Canadian companies is that on. So the 2025 as an example, there's 400,000 credit reports that have been pulled on Canadian companies. But of course, that's multiple CreditSafe customers looking at the same Canadian business. There's only actually 30,000 unique Canadian companies that have been looked at as part of that 400,000. And that number doesn't really grow much from year to year. You can see it's gone from 24,500 in 2023 to 31,000 last year. But that's a tiny percentage of all Canadian companies. If there's
Right.
1.5 million or 2 million companies in Canada, only 30,000 are being looked at by US or European or Japanese businesses, which potentially means it's only that number of companies that are exporting or importing from Canada. Which again, when we look at organizations like EDC, who are here to help Canadian companies export and grow their footprint overseas, that ties in with the sort of numbers that they have as well, that it's around between 25 and 50,000 Canadian companies that actually regularly export outside of Canada. So I thought that was fascinating just to see a huge interest in Canadian companies from a huge number of non-Canadian businesses, but that pot of Canadian companies is relatively small.
Right. So there's really been a dramatic change in 2025 there. That's grown exponentially.
There is, and whether that's something to do with what you just mentioned about the US and Mexican trade agreements, whether it's just, because the CreditSafe customer base doesn't grow by a huge number, 300% in customers every year.
Right.
So it's not the fact that we've added more and more customers who are using Canadian data, it's our existing customers who just have more interest in Canadian businesses. So yeah, I thought that was fascinating. It looks like it's an ongoing trend that Canadian companies are more and more relevant globally, but as I say, a relatively small number.
Yeah, that's really cool. That's really neat. That's a neat story right there.
Yeah. And then the final one, we've looked at Canadian companies, so all of our customers here in Canada, which countries are they looking at? So are they looking at credit reports in businesses in the US or in Europe? Again, as we'd expect, 67% of all credit reports pulled by Canadian customers outside of Canada are US companies. We know that doesn't change. That's always 60, 70% every single year. It's followed by UK, France, and then Netherlands. So again, a lot of the companies where businesses in those countries are looking at Canada, vice versa, the Canadian companies are looking at credit reports on companies in those countries as well. So it seems to be a correlation with UK, France, Netherlands, Germany, and of course, US by far and away the biggest one.
Right, which makes a lot of sense.
Which makes sense.
Yeah. So yeah, what you're really hearing about in the headlines is proving true in at the data level too. Like it's showing up in the numbers.
Absolutely.
Yeah. That's awesome. I wonder, do we have any questions? We still have like a couple minutes. I'm looking to my mystery assistant over here.
One in the chat there that's interesting from James.
Yeah, okay. In the chat. I'll open it up and see what we've got. On the current debt trends, there appears to be a shift from revolving lines of credit towards term-based loans. What are your thoughts on that transition? And so I'll definitely answer that one. I don't know if Steve wants to field it, but I know from our perspective, we're seeing a lot of debt consolidation. So we have our consultants do work with all of the large banks and just kind of checked in with them to say, does this make sense? Like what's happening here? We're seeing financial institutions, they're really starting to monitor problem accounts and they are offering debt consolidation, restructuring. So it's not really surprising that we're seeing that. And anything else? I think that's pretty much it.
When will Q1 data be available?
When will the first quarter data become available? I usually get it. So what are we now? We're March, April, May, June. It'll probably, our webinar will be in June. And I usually get it a few weeks before that. And it's always down to the wire. So if you work directly with our consultants, they might have access to it probably at the start of June. I'm going to guess. That's probably safe. So that'll be interesting to see how the things evolve because I know I'm paying more at the pump myself and so are all of you and everything has gone a little bit fun over the last quarter. So I guess with that, I will wrap it up here. Steve, thank you so much for joining. That was really cool to see everything that's going on around the globe, find out what the trends are like in other regions. And I'm sure everyone who joined us today probably got a lot of really cool insights in there too. So thank you for that. It was a pleasure having you. Thank you to everyone at Equifax behind the scenes who helped keep things running smoothly because we're navigating this new platform, and that was kind of fun. So that's thank you, team. And also thank you to every one of you who joins us every quarter. We really appreciate the time that you take to spend an hour with us. We hope that you find these sessions informative and they help strengthen your business decisions. So enjoy the rest of your day, and we'll see you next quarter.